Have you ever stared at a stock chart and it just looks like a bunch of random, chaotic squiggles? I mean, it's just noise, right? Well, what if I told you that underneath all that chaos, there's a hidden rhythm, a predictable pulse? Today, we are going to pull back the curtain on Elliott Wave Theory, a really fascinating way to find order in what looks like pure market madness.
And that's the key right there, the crowd. See, this isn't just about crunching numbers or looking at lines on a chart. When you get right down to it, Elliott Wave is really a theory about people, about human psychology. It's about those natural, repeating swings between optimism and pessimism that make us all buy and sell, creating these patterns that have been playing out for decades.
So here's how we're going to break it all down. First, we'll look at the basic rhythm that Elliott found. Then we'll get into the two main parts, the powerful motive wave that drives the market and the corrective phase where it takes a breather. And finally, we'll see how to put all the pieces together.
Okay, so who's the guy who discovered this secret rhythm? Well, meet Ralph Nelson Elliott, or R.N. Elliott. And get this, he wasn't some Wall Street hotshot. Nope, he was an accountant. In the 1930s, when he was 66 years old, he decided to dig into 75 years of stock market data. We're talking yearly charts, monthly, weekly, all the way down to half-hour charts. And he did it all by hand. Just imagine that.
And after all that painstaking work, he had this huge breakthrough. He realized the market isn't just some random walk. It actually moves in specific repeating patterns. But here's the really wild part. These patterns are fractal. That just means the same shapes pop up over and over again on every time frame, whether you're looking at a chart of the last 100 years or just the last 5 minutes.
So what was this incredible pattern he saw everywhere? Well, it turns out that every single market cycle, no matter how big or small, is made up of just two main phases. And here they are. You've got the motive phase, which is the part that pushes the market forward in its main direction. And then you have the corrective phase, which is the part that pulls it back a bit. The motive phase always has 5 waves, and the corrective phase always has 3. This 5-3 pattern, this is the absolute foundation of the whole theory. It's like the market's heartbeat. 5 beats forward, 3 beats back.
All right, let's zoom in on that first part, the 5-wave motive wave. You can think of this as the engine of the market. It's the powerful sequence that really drives the main trend, whether that trend is pointing up or down.
Now, the most common and, honestly, the most important type of motive wave is called an impulsive wave. It's this clean 5-step pattern that traders are always looking for. Why? Because it's the clearest sign that the market is moving with real conviction and strength. Let's walk through the story this pattern tells. Wave 1, that's the first little push, usually started by a few smart money investors. Wave 2 is when doubt creeps in and you get a little sell-off. But then you get Wave 3. This is the big one. This is when the crowd finally catches on and that herd mentality creates this long, powerful move. Wave 4 is just a little pause, some profit-taking, and Wave 5 is that final gasp of energy before the trend runs out of steam. It's that classic 2 steps forward, 1 step back.
Now, this isn't just about finding a pattern that kind of looks right. There are 3, and I mean unbreakable rules. Rule 1, Wave 2 can't ever fall below where Wave 1 started. If it does, that first move was a fake out. Rule 2, Wave 3 can never, ever be the shortest of the 3 forward waves. It has to show that crowd power. And Rule 3, Wave 4 can't dip down into the same price territory as Wave 1. If a pattern breaks any of these, it's not a real impulsive wave, period.
Okay, so after that powerful 5-wave engine pushes the market forward, things have to cool off for a bit. The market needs to catch its breath. And that brings us to the corrective phase, the second half of our 5-3 pattern.
So, unlike the nice, clean progress you see in a motive wave, corrective waves are messy. They're often tricky and confusing. We label them with letters, A, B, and C, and they basically represent the market's indecision. This is where people are taking profits, or the bears are trying to fight back, before that main trend kicks back into gear.
And there are 2 main flavors of correction you'll see most often. First is the zigzag. This is a sharp, quick, and deep move against the trend. Then there's the flat. This one's more of a sideways grind, where the market just chops around, not really going anywhere, while it digests the last big move.
Okay, so how do we actually use all this? We've got our 5-wave engine and our 3-wave correction. Now let's zoom back out and see how these pieces build on each other, and more importantly, how traders actually measure them.
And here's where it gets really mind-bending. That entire 8-wave cycle we just talked about, the 5 waves up, the 3 waves down, that whole thing can actually combine to form just wave 1 and wave 2 of a much, much bigger pattern. That's the fractal nature of the market in action. The same patterns are nested inside of each other like Russian dolls across all time frames.
So you're probably wondering, how do you measure these waves? How do you know where they might end? Well, the go-to tool for that is the Fibonacci sequence. It's a mathematical pattern you see all over in nature, and it turns out the relationships between market waves often line up with these same ratios. Don't think of it as magic. Think of it more like a ruler for market psychology that helps you estimate where the turning points are likely to be.
So here's how that works in the real world. Say you've identified a wave 1. An Elliott Wave analyst will then be watching to see if wave 2 pulls back to that 50% or 61.8% Fibonacci level. If it does, and then starts to turn back up, that gives them more confidence that a really powerful wave 3 could be just around the corner. These ratios give you a kind of probabilistic roadmap.
But at the end of the day, and this is so important to remember, Elliott Wave is not a crystal ball. Its real power isn't about predicting the future with 100% accuracy. No, its power is in giving you a logical framework, a map of probabilities that's based on the predictable way we humans act in groups. It helps you understand the story the market is telling you right now and what the most likely next chapter is.
Which kind of leaves us with one big question. You know, in today's world of AI, high-frequency trading, and markets that never sleep, can a theory that's almost 100 years old, one that was figured out by a guy drawing on charts by hand, can it really still give us an edge? Or is the rhythm of human fear and greed just a timeless constant that never really changes? That's something to think about.